In this demonstration, we're going to carry on with building our discounted cash flow analysis model for the investment appraisal of a single tenanted property. We have started with the estimate of the operations for year one. What we have to do is forecast the operations cash flows for years 2 and following. We also have to estimate the sale cash flow and then bring those back to a net present value and internal rate of return. You can go to the PowerPoint presentation for a little bit more background and detail. It will basically take you through the background and theory issues that are behind this. I'll be basically going over the important ones as we work through the demonstration. But it's up to you to go back and check out for what I left out from the PowerPoint presentation, rather than going in and out of the PowerPoint and then the Excel all the time. Okay, first thing we're going to need to do is to set up our cash flow table, if you like. We do that by simply writing in the numbers of the years. You'll notice here I'm going across to year 6. Now, in our model, we're only doing it for 5 years. I'm calculating the year 6 values because it's necessary when it comes to forecasting the estimated sale price at the end of the sale period. Remember, all DCF must have a notional sale at least, even if you don't intend to really sell it, so that you can capture, if you like, the notional future costs and benefits off into the future. Okay. Calculating the rent for year 2 is as simple as escalating the rent for year 1 by 1 plus the market growth rate. So I take the rent from the previous year, I multiply it by 1 plus the market growth. I'm going to hit the F4 key to add the absolute dollar signs into the Excel cell address. I'm going to find that useful because when I fill this equation across, it will always go back to the market growth rate at H3. If I don't put the dollar signs in, it will walk across and take different cells as the equation moves across. Okay. Now that was really only writing one equation. I got to fill the rest. Even better news is the way that I can now fill this down and calculate the signage costs off into the future exactly the same way. Unfortunately, I've got a little bit of a border problem here because I have been a little bit of a cheat and copied those equations, but that's all fine. I'm going to continue to do that to come down and deal with the vacancy in the same way. I don't really need the equation there, so I'll take it out and I'm going to fill this across as well. And so now, basically, with only one real equation written, but a lot of copying and filling, I've calculated all of my revenues. The same mathematics is used for the expenses. Here again, I'm going to take the management for the previous year. I'm going to multiply it by 1 plus the property growth rate, the market growth rate. Now you'll notice that we've been talking about multiplying by 1 plus I to the n, and yet these equations don't have the n power in them. And the reason for that is I'm not bothering to go to the year number and work them out all from the starting value. I'm simply working them out iteratively, one after the other, all based on the previous value. That actually works out to be necessary in this particular case because my starting values are the first year values, not the estimates of the exact starting point of the estimate period. Kind of a little bit of a technical problem, but basically because the first year's cash flows are not escalated, it sort of messes up the 1 plus I to the n. It really should be 1 plus I to the n minus 1, as in the power should be 1 less than the year number. That sounds a bit complicated and will probably fry some people's mathematical brains, so simply don't worry about it. You only have to apply this equation, which I'll describe as iterative, and it all works out very nicely. Now here I need to apply the absolute button. By not applying it, you'll notice that I get the wrong equation coming across. It doesn't escalate after year 1. Here I'll escalate it, and again I'm going to come down and simply fill down. And so my model now can take account of any number of expenses. Again, I've only written one equation. However, you'll notice that there is a yellow highlight here, and it's important that we notice what's going on. This is for the maintenance expense. The important thing about the maintenance expense is that it doesn't escalate at the property growth rate, because maintenance relates to labour costs, materials costs and so on, which tend to follow other escalation rates. We're going to use the CPI. If you want to be really precise, it probably should be the building price index, and it can even get more precise after that. But for our purposes, the idea of using a different escalator for the maintenance at least introduces you to the idea that escalations can be different. I could write out this equation right from start, but I like to tell people that I'm a very lazy person. I'm simply going to adjust this equation so that instead of bringing in the market growth rate, it's going to work on the CPI. And so that corrects the first one, and then I'll fill that across, and it's all done. Okay, here we've basically done 2 equations, or maybe 2.5 equations, and we've done the entire operations forecast. That is really easy. Not only that, but if we want, we can continue to fill these equations across not just to 6 years, but to 26, 36, 106 if you want, simply by filling across. Very easy. Basically 2.5 equations and fill across for as far as you want. And I do recommend that when you're building your own models, run them probably to at least 20 years. You may want to go out to 40. Doesn't really matter. And we're going to show as we go along how we can make it so that you can control how much of your model might go for 100 years. You might decide to use 25. We can control that. That's going to be something we're going to come along when we get to estimating the end sale price and so on. We're getting ahead of ourselves. Okay, we need the total revenues. Well, I've already worked that out. It's simply a summation, and so I'm going to fill that across. That's all done. I've got my summations here for the total expenses and the earnings before interest and taxes, the EBIT, otherwise known as the net operating income, EBIT or NOI. Interest cost, we've calculated here is 15,120. Because we were dealing with an interest-only loan, the interest cost doesn't change year to year, so I can simply import the interest cost from the previous year, fill that across, that's all done. Likewise, the before tax cash flows can be sent across.